Welcome back. We're doing Wallgreens Boots Alliance. This is a company that I've seen in a lot of value investing circles, especially some YouTube channels here. And on top of that, they just had some pretty strong quarterly earnings results reported on January 6th that exceeded expectations. So I wanted to do a valuation for ourselves. What I'm going to do in this case is going to be different. I'm going to look through the press release for the quarterly results, and then we're going to take a detailed look in the business section of the annual report to get a better idea of what they're doing and some strategic plans for them moving forward. All right, so let's get started with this press release. Great headline, right? Wallgreens Boots Alliance exceeds expectations. Perfect. All right, so look at this earnings per share. First quarter earnings per share from continuing operations was $4.13 in one quarter. That's unbelievable, right? That gives you like a PE close to 12, right? So look at this. Current share price is $52.44, and then you divide that by 413, and they have a PE of 12.7 just for that one quarter. So that's awesome. Now, the catch, because there's always a catch whenever something's too good to be true, is that it was due in part to a high other income, so the adjusted earnings per share is really closer to $1.67. All right, so keep that in mind. And as far as why they exceeded expectations, if you see here, it was driven by COVID, vaccines, and testing. One thing you really want to keep in mind whenever you see high earnings for a company is, was it due to something that's repeatable? Now, are COVID vaccines and testing repeatable income? I don't think so. I think that we're kind of done with it after Omicron, but I would have been wrong because I thought we've been done with it like 3 or 4 times already. So what do I know, right? But that's just always a question you want to ask yourself whenever you see a high step change in income is this repeatable, right? That's why we subtract out things like other income that's not repeatable. And then I want to show you this too, their fiscal 2022 outlook. So if you look at this, they are increasing their full year adjusted earnings per share guidance to single digit growth from flat previously. So what does that mean? It means that they thought they were going to have 0% growth, and they're increasing guidance to low single digits. So less than 5, let's say between 0 and 5. I'm just going to say 3%. And that's actually going to be what I put over here in the outline for my growth. What better source than from the horse's mouth, right? Low single digits is what we should expect for growth. All right, that's all I want to look at for the quarterly press release. I want to go into the annual report because there's a lot of interesting things here. So one thing strange with Walgreens is that their quarterly results and annual reports come out on some strange dates. So their fiscal year end is actually August 31st, and then all their quarters are 3 months past that. So it'd be the end of August, the end of November, the end of February, and the end of May. So just keep that in mind. So this report was actually going back to August 2021 was when this is from. Okay, so in general, the annual reports of companies are the best places to go if you want to learn more about the business itself. You should always read it before you invest in it because it really helps you understand what's going on. So I want to show you some highlights here in addition to the general copy and paste I do from Yahoo Finance. So I think everybody knows this, but Wallgreens Boots Alliance is a global leader in retail pharmacy. That's from the business overview section. This is what I think is interesting. There's a couple points here. Okay, strategic update. Last year in October, they announced the launch of a new healthcare strategy. So they plan to become a leader of local clinical care services by leveraging its consumer-centric technology and pharmacy network to deliver value-based care. So what does that mean? That means that they're going to be using all their store locations to also offer, walk-in clinics, vaccines, testing. So maybe that stuff that we talked about is repeatable after all, just not COVID related. But that's pretty interesting and definitely promising for future growth. So I thought that was neat. Next, I want to show you something about their industry. So there's usually a section here on the annual report about an industry update or industry overview, and it's super informative. I think reading this and then reading the same report of competitors and their view on the industry is a great way to learn more about the industry as a whole and get a feel for what direction the company's headed. Okay, so first line here, retail pharmacy industry across the globe is highly competitive and dynamic and has experienced consolidation in an evolving competitive landscape. All right. That is long speak for we got a lot of competition and we're probably going to have low margins. That's how I read it. All right, now they do give some guidance that they expect to have strong growth in the future, and they blame it on the baby boomers needing more prescriptions. That's what the rest of this says if you read it. You could pause and read this if you want, but I'm just kind of giving you the high level overviews. Okay, so this is what I thought was super interesting and pretty disappointing. All right, so the retail pharmacy industry relies significantly on private and governmental third-party payers. What does that mean? That means whenever you go get your prescription or whenever somebody gets a prescription, they're usually not the ones paying for it. It's usually private health insurance or government health insurance, right? So that makes the pharmacy super dependent on those two entities. And being dependent on the government is never fun. Especially, and look at here, they say this, in many European countries, the government provides or subsidizes healthcare and regulates pharmaceutical prices, all right? That is terrifying as a business, right? The last thing you want is for your price to be regulated, because then you have really no power to raise prices, even if your raw material costs are going up. So that's kind of spooky. And if you look here, they actually call it out specifically, right? When government authorities take actions that restrict eligibility or reduce prices, sales and margins in the retail pharmacy industry could be reduced. Well, I would say they will definitely be reduced, not could be reduced. That's all I wanted to go over for that section. I wanted to show you this real quick. They break themselves down into the United States and international segments. So the US in one, and then all the rest of the international in another. And if you look, $112 billion of their sales come from the United States and only $20 billion from international. So that's like over 80% from the US. So if you're judging, their longevity, their competitive strength, just focusing on the US is fine. So that's what I want to do here. They have kind of an update on the United States. And I thought this was really interesting. The company is a market leader in the US. Let me highlight this. And they have about 78% of the US population lives within 5 miles of a Walgreens or Duane Reade. I don't know what Duane Reade is. I live within 5 miles of a Walgreens for sure, probably within 2 miles. It might be a CVS now that I think about it, but I don't really know. I think it's a Walgreens. But anyway, this is also promising for that strategy shift that they're going to do, where they're going to be more of a clinic based for some people. And that's a strong starting point, right? To be within 5 miles of almost 80% of the population. So that's pretty good. All right, that's all I wanted to go over for the annual reports. I'm going to skip the share price history section. I just want to save time and go right to the income statement. All right, first up, total revenue. We always like to look at this, make sure that it's growing. It is growing. That's all we look at here, check mark. All right, operating margin, I'm a little worried here. This is what they said was going to be low based on, what the heck, 2%, 2 to 4%, that's so bad. That's terrible. I feel bad for them. I know they kind of are blaming it on the government a little bit and, blaming it on Brandon, but still, you're the ones still getting 2 to 4%. It's not fun. And it's just shrinking recently. Oof. I think it goes without saying, but this is a huge red flag. This by itself would probably make me not buy the company, but that's just me. Don't leave the video. There's still more to learn, I promise. All right. Interest over operating income. Okay, so this is a great way to judge a company's debt position. How much debt is it carrying? What this is all the interest payments that it's making divided by its operating income. And you really want this below 15%. I prefer single digits personally. I mean, I prefer 0 personally to have no debt, but I'm okay with less than 10, less than 15%. And they're kind of right at that okay range, right? 10% recently. I'm not going to count these outliers. Just checking this, making sure it's not like 20 or 30%, because those are some big red flags if it gets that high. Now let's go to our pre-tax income. This is going to be our first valuation metric. And one thing I didn't note here is that I'm using Yahoo Finance's raw data here, and there's a little bit of a delay with quarterly results coming out and when it gets in the software. So this is actually only going to August 2021. So I don't have the most recent results. So we're going to pull those up in this calculation. So what I want to do, I want to get the last 4 quarters summed. So I take the last 3 because that's what I have access to right here. So the last 3 is $2.6 billion is the sum. So 2.6, and then I'm going to add the most recent ones from the quarterly results. So I'm going to go get the quarterly report real fast. Okay, so here's the quarterly report for Wallgreens Boots Alliance that they just released on the 6th. And I'm going to go down here to the table of contents and get statement of earnings, income statement. Okay, and then I'm here, 3 months ended November 30th, and I want to get the income before tax, pre-tax income, so earnings before tax right here. 3.8 billion. What? That's crazy. Oh, no, okay. So we got adjusted, right? So 3.8 billion minus, we're going to subtract this other income because that's not income from operations. You could see their income from operations was only this number. So 3.8 minus 2.6. So back in the calculator now, I'm going to do plus 3.8, but I'm going to subtract 2.6. Oh, wow. 2.6 plus 3.8 minus 2.6. That's some tough math. Good thing I had the calculator, right? All right, 3.8. That's embarrassing. Okay, so $3.8 billion is going to be my yearly pre-tax income estimate. Let's go to earnings per share. Remember, we're skipping growth. We already got our growth rate based on their forecast. Where is it? Where's diluted earnings per share? There we go. All right, same thing here. I need to get the quarter that they just reported on. So I'm going to sum these last three. Let me sum the last three. I get 329 as the sum of the last three, 329. And if you remember from the press release, it was $1.68 was their adjusted number. So plus 168. All right, earnings per share totals to $4.97. Great. Let's go to the balance sheet. All right, total tangible assets. What we're going to do with this is get a pre-tax return on tangible assets. I love return on tangible assets because I think it's so intuitive as far as how people judge businesses. So a great example of this is like, if you're going to start a new business, the first thing you want to ask yourself is, how much money am I going to have to put into it to buy the assets? And then how much are those assets going to pay me on a pre-tax basis? So let's see what it is for Walgreens. All right, so what we do is we take the pre-tax number that we got, the $3.8 billion, and we divide by how many assets they have. So they have $60 billion of assets. So 3.8 divided by 60, and I get a return, pre-tax return on tangible assets of 6%. Okay, that is not impressive at all. That's like starting a business and you're going to buy $10,000 worth of assets to start this business, but it's only going to pay you $600 a year. Not great. That's another red flag, all right? It is what it is. And on top of that, this is a return on tangible assets. So if I included things like goodwill, look at their goodwill. Let me pull that up. Their goodwill and intangible assets are over $20 billion. So if I included those, the return on assets would be even lower. That's kind of our second major red flag, in my opinion. All right, well, we'll keep going. Let's look at our debt to equity ratio. So I know we already kind of judged the company's debt load, but I really like looking at this too, because it's also something that's really intuitive. So this is all the company's liabilities divided by the equity, and it kind of tells you how leveraged the company is. So in general, I think under 4 is okay. 4 is what you would get if you bought something with 20% down, right? If you paid 20% down for something, you'd have 20% equity and 80% debt. So 80 divided by 20 is 4, right? That would be your debt to equity ratio. Again, some hard math, but good thing we got the calculator, right? Okay, so 4 is kind of my max. I prefer under 2, really. I prefer under 1. I think I try to keep like personal finances below 1 or around 1, and I think that's a good rule of thumb. But decreasing recently, that's okay. I think that this is kind of a wash for me. They obviously went into some debt here to get, I think it was an acquisition, but recently they've been paying it down, either paying down the debt or growing equity, both of which are fine by me. So I like the recent trend. I wish it would be a little lower, but in general, it's in our okay range. So not a check mark, but not a red flag either. All right, and lastly, for the balance sheet, we're going to look at ordinary number of shares, shares outstanding. Okay, so this tells us, is the company diluting shares or are they buying shares back? So if they're diluting shares, it's going to be going up. And if they're buying shares back, it's going to be going down. It looks like they bought shares back for a while, maybe like 2015 to 2020. But recently, they're kind of happy with the number of shares they have, or they have other things that they can do with the money that's better. That's not a major concern for me. I like that they bought shares back here. I don't really care that they're not buying it back now. In general, if a company is buying back shares, that's usually a good sign. I say usually because there is one special case where it's not a good idea. And that case that you need to be looking out for is whenever a company is buying back shares, no matter the price of their stock, just to keep it propped up or because they have nothing else to do with the money, so they're spending it buying back overpriced shares. That's rare that you see that, but just keep an eye on that. So like I said, it's usually a good sign if a company's buying back shares. If they're not buying back shares, that's not a bad sign necessarily. So this doesn't get a check from me, but it doesn't really get a red flag trigger either. So it's all right. Let's go to the cash flow statement. Free cash flow. We're going to go fast through this one. I'm ready to get to the valuation. All right, so free cash flow, I'm just going to take the average of the last 8 quarters. So the average of the last 8 quarters is $1 billion. That's easy. 1 times 4. I'm not going to use the calculator for this one. All right, 1 times 4 is $4 billion. That's our free cash flow number, and it's growing. That's a good sign. Like to see this trend. All right, let's go to CapEx. Always like to compare CapEx to depreciation though, so I want to look at depreciation first. I know it's not on the outline, but I always like to look at it. Okay, so they are depreciating their assets at a rate of about $500 million per quarter, $500 million per quarter. Let's look at their capex. And I'm going to explain why we do this right after I look at capex. Okay, capital expenditures is about about $400 million a quarter. Okay, so this is good. This is actually a positive for me. What is depreciation versus capex? Depreciation is how much you're discounting your assets on paper. So how much value they're losing every quarter on paper for your income statement purposes. And then capex is reinvestments back into those assets to keep up with them. So where you could get in a bind is if you have very, very low depreciation and you're getting your high income because you're not really having a lot of depreciation, but then you go look at the cash flow statement and you see really high capex and little growth in a company. And that means that even though they're saying their assets aren't depreciating that much on their income statement, they're having to reinvest a lot of money in capital expenditures to keep up with the assets. So that's something to look out for. Another thing to look out for is if capex is really, really low, so like less than half of the depreciation, that could be a company that's kind of sacrificing the future for the present, where their assets are depreciating pretty harshly, but they're not reinvesting in them at all. And it looks like they're generating a lot of cash in the short term, but really what they're doing is like deferred maintenance and stuff on all their assets. And it could be a bad sign for, cash flow in the future. What I like to see first off is that they're pretty close together. If capex is higher, I want to see growth in the company. In general, like I said, I like close together and I like capex a little bit lower than depreciation. That's just my taste, but I think that makes the most sense intuitively. And that's what we see here. So check mark here. Let's go to the valuation. Let's get a number. All right, first one, pre-tax income times 10 divided by the number of shares. This one is really crude. This is a rule of thumb method, but it has served me so well throughout investing that I almost think it's sometimes the only one I should ever look at. So 3.8 times 10 divided by the number of shares, so 0.864. All right, $44 a share, that's our target. It's usually on the lower side, but that's kind of why I like it. I am a very conservative investor whenever it comes to price targets. All right, next one, earnings per share formula. So what we do is we take that 497, multiply by 8.5 plus 2 times our growth. And our growth was what? 3%. All right, and we get a target price of $72 per share. This formula comes from The Intelligent Investor from Ben Graham. It's usually on the high side, and he wrote it not as a valuation that he uses, but as kind of a rule of thumb formula that encapsulated all these complicated formulas that were out at the time. So he saw all these crazy formulas for growth stocks and to value earnings per share and growth and get the perfect multiple for your PE. And he just took all those and said, this little formula here pretty much encapsulates or gets close enough to all what these guys are saying. So that's why I use it. And then lastly is a discounted cash flow. All right, so I take my free cash flow number in billions. I take a perpetual growth rate. I'm going to go a little bit lower than their growth rate. So their growth rate was 3%. I'm going to go 2%. And then discount at 15%. So discount rate is also required rate of return. I see a lot of people use like 12%, 10% for required rate of return. I think you want to be between 10 and 15% whenever you do it. 15% is definitely the high end. But like I said earlier, I'm very conservative whenever it comes to valuations. All right, so 35.4 was our market cap, and I divide by 0.864. And I get $41 for our DCF share price. Okay, average price target, $52. That's exactly what it's selling for now. I mean, not exactly, it's selling for $52.44 now. I see a lot of potential here. I think if they can continue to get their income around that $1.70 per share range, then you're going to see a huge spike in the share price. And I think that's definitely possible with their healthcare shift that they're talking about, where they're going to try to do more clinic work. All that being said, though, for me, this is one I'm not buying. It's just, use the quote up top, it's not a pitch I'm swinging at. The margin's too low for me, and the return on assets is way too low. In addition to that, I really don't like the potential for increased government intervention. But that's just me. That's how I'm going to approach the stock. You might have a completely different outlook. I suggest that if you're going to buy it, you do your own research and make yourself feel comfortable, at least with all the red flags we talked about. But that's really all I have. I hope you learned something. I hope you enjoyed the video. If you did, like and subscribe. I'll see you next time.